Welcome. Today, we're diving into the concept and role of a mutual fund. This session is part of the NISM Series VA, focusing on Chapter 2. We'll explore what mutual funds are, how they work, and why they matter in the world of investing. Let's get started. Let's start with the basics. A mutual fund is a professionally managed investment vehicle set up as a trust. It pools money from many investors who share similar goals. This combined fund then invests in a variety of assets: stocks, bonds, gold, and more. The investors, called unit holders, share in both the profits and the losses. And all of this is managed by an asset management company, or AMC, which handles the day-to-day decisions for a fee. Mutual funds play a crucial role in the economy by connecting everyday savings to the broader capital markets. They help turn small amounts of money into significant investments, a process we call the financialization of household savings. This, in turn, fuels large-scale funding for government and corporate projects. Along the way, mutual funds create jobs within the financial services sector and boost government revenue through taxes on securities. They're a vital link in the economic chain. Let's talk about the role of market stabilizers. They act as a counterforce when foreign investors pull out, helping to balance the selling pressure. Domestic inflows keep liquidity flowing, especially during times of global market stress. Systematic investment plans, or SIPs, bring a steady, reliable stream of capital, avoiding sudden shocks. Because of their size, institutional investors can also keep a check on poor corporate governance. Altogether, they help markets find efficient and fair prices for securities. Every investment scheme starts with a clear, legally binding objective. This objective shapes everything. It defines the scheme's risk and return profile. Some schemes prioritize safety, aiming to preserve your principal. Others focus on liquidity, making sure you can access your cash quickly, often overnight. And then there are those designed for returns, either through capital growth or steady income. Understanding these objectives helps us choose the right scheme for our goals. When we talk about investment objectives, there are two main types to keep in mind: growth and income. Growth focuses on building wealth over the long term, aiming for capital appreciation. Income, on the other hand, targets regular payouts like dividends to generate steady cash flow. Many schemes blend these approaches, investing in equities for growth and debt for income. A balanced objective tries to strike a mix between both. Importantly, the chosen objective also guides which benchmark we use to measure performance. Let's break down what an investment policy really means. First, it takes the overall objective and turns it into a clear, actionable plan. That plan covers key areas, like asset allocation, which is how we balance equity, debt, and cash. Then there's the investment style, whether we focus on growth stocks or value stocks. We also set diversification limits to avoid too much risk in any one stock or sector. Finally, all of this is clearly laid out in the scheme information document, so it's transparent and easy to understand. Let's break down how units and face value work in this context. Unit holders own units, which represent their share in the investment pool. The number of units they get depends on how much they invest, divided by the sale price per unit. Typically, each unit has a face value of 10 rupees. That's the accounting base. Dividends are always calculated as a percentage of this face value. Finally, the total unit capital is the number of units outstanding multiplied by the face value. Let's talk about net asset value, or NAV. It shows the true market worth of a single unit in a fund. We calculate it by taking all the fund's assets, subtracting its liabilities, and then dividing by the total number of units. Assets include things like stocks, bonds, and any interest earned. Liabilities cover management fees and other expenses. NAV is important because it's the price investors use to buy or redeem their units. It's the real snapshot of value at any given time. Let's talk about mark-to-market, or MTM. It's the process of valuing securities using their current closing market prices. This happens every single day, so the net asset value, or NAV, always reflects the latest market conditions. MTM keeps things fair, new investors pay the right price, and existing investors don't end up subsidizing anyone else. Because prices change daily, the NAV of mutual fund schemes will naturally fluctuate day to day. Assets under management, or AUM, is basically the total market value of all the money that unit holders have invested. We calculate it by multiplying the current net asset value, or NAV, by the total number of outstanding units. AUM grows when the market value rises or when new money comes in. It shrinks if the market value drops or if investors redeem their units. Having a large AUM is a big advantage. It gives us more leverage to negotiate lower costs with brokers. Let's talk about recurring expenses and the total expense ratio, or TER. These are the annual fees charged to manage the scheme's portfolio. They cover everything: fund management, audits, registrar and transfer agent services, and custodian fees. The TER represents these expenses as a percentage of the scheme's daily assets under management. Importantly, SEBI sets strict limits on how high this percentage can go. Remember, higher expenses directly reduce the net asset value, or NAV, that investors ultimately receive. When it comes to investing, professional management makes all the difference. Our portfolios are handled by qualified experts, fund managers who know the markets inside and out. They're supported by dedicated research teams and analysts, constantly digging into the latest data. We keep a close eye on both big-picture trends and the finer details. Using sophisticated trading systems and institutional tools, we stay ahead of the curve. This means you don't have to worry about daily market moves. We've got it covered. Diversification means spreading your investment across different sectors and companies. It's the idea behind the saying, "Don't put all your eggs in one basket." This approach reduces unsystematic risk, the risk that comes from any one company failing. Even small investors can build a diversified portfolio with just 500 rupees. The result? Lower overall volatility compared to buying a single stock. It's a simple way to manage risk and protect your investment. When we pool large sums of money, we unlock some serious advantages. First, buying in bulk means we can purchase securities at better rates. The sheer volume also drives down brokerage fees and reduces market impact costs. Plus, research and admin expenses aren't just on one investor, they're shared across millions. This scale even opens doors to wholesale bond markets, which individual investors can't access. And with that kind of negotiating power, we get better execution on trades. This is the power of economies of scale. Transparency is key when it comes to building trust with investors. That's why daily disclosure of the net asset value, or NAV, is mandatory on both AMFI and AMC websites. Investors also get a clear view of the full portfolio holdings, either every month or every 2 weeks. Detailed scheme information is available in documents like the SID, SI, and KIM. Fact sheets show how the fund is performing against benchmarks. Plus, investors receive annual reports and transaction statements to keep them fully informed. Let's talk liquidity, one of the key advantages of open-ended funds. You can redeem your investment on any business day, and the money usually hits your bank account within 1 to 3 days. Close-ended funds work differently. They're traded on stock exchanges when you want to exit. Some institutional-grade liquid funds even offer instant access up to $50,000. The best part? You don't have to find a buyer yourself. The fund house takes care of buying back your units, making the process smooth and hassle-free. One big advantage of mutual funds is tax deferral. The funds themselves don't pay tax on the income they earn. Instead, investors only pay tax when they sell or redeem their units. This means your capital can grow on a gross basis, benefiting from compounding over time. Some schemes, like ELSS, even offer direct tax deductions under Section 80C+. There are different tax rates depending on whether your gains are long-term or short-term. This setup helps your investments work harder for you. Convenience is a game changer when it comes to investing. First, tiny ticket sizes, as low as 100 to 500 rupees, make it easy for anyone to start. Then there's the SIP facility, which helps us invest automatically and stay disciplined without thinking twice. Online transactions are simple, whether through websites, apps, or platforms. Plus, record keeping is streamlined with just one folio covering many schemes. And standard features like nomination and joint holding. add that extra layer of ease and security. One big advantage we have is regulatory comfort. The whole system is tightly regulated by SEBI, which means small investors get solid protection. Then, AMFI steps in to define the industry's code of ethics, keeping everyone honest. The trust structure is another layer. It keeps the assets safe, even if the asset management company runs into trouble. Independent trustees watch over both the AMC and the custodian, making sure they play by the rules. Plus, SEBI mandates standardization across all scheme categories, so things stay clear and consistent. When it comes to this investment approach, there's a key limitation we need to understand: no customization. Investors can't pick or choose specific stocks themselves. Instead, thousands of people share one common portfolio. Only very large, high-net-worth investors get the option to customize through specialized services. Everyone else has to trust the fund manager's active decisions. Plus, the portfolio has to stick closely to the rules set out in the official mandate. Customization just isn't part of the deal here. Let's talk about the second limitation: costs and overload. First, management fees are due even when the fund loses money. That's a tough pill to swallow. Then there's the total expense ratio, or TER, which chips away at what investors actually take home. On top of that, the sheer number of fund options can overwhelm anyone. It's what we call choice overload. Picking the best fund isn't simple. It demands serious research or expert guidance. And don't forget, entry and exit loads can further eat into profits. When it comes to investments, performance hinges on two key things: market movements and the skill of the manager handling your money. Unlike fixed deposits or saving schemes, returns aren't guaranteed or fixed. This isn't an insurance product, so your principal can go down as well as up. Remember, past performance doesn't promise future results. And finally, risk is baked into the very securities you hold. There are simply no guarantees here. Open-ended funds are designed to be flexible and accessible. Investors can subscribe or redeem their units whenever they want. There's no fixed schedule. The fund's size changes daily, reflecting new investments and withdrawals. Because there's no maturity date, the fund keeps running indefinitely. Transactions happen directly with the fund house, always at the net asset value, ensuring transparency and fairness. This structure makes open-ended funds a popular choice for those seeking liquidity and ongoing access. Let's break down how close-ended funds work. First, you can only subscribe during the initial offer period. That's your one chance to get in. The maturity date is fixed and known from the start, so you know exactly when the fund will end. Unlike open-ended funds, the number of units stays the same because they're not redeemed daily. After the offer period, these units trade on stock exchanges, giving you liquidity. But remember, the market price can be quite different from the net asset value. This is what makes close-ended funds unique. Let's talk about interval funds, a hybrid between open-ended and closed-ended structures. They only allow transactions at specific, preset intervals. These intervals have to be at least 2 working days long. Plus, there's a minimum gap of 15 days between 2 intervals. Meanwhile, the units are listed on stock exchanges, providing a level of liquidity in between. This setup balances flexibility with stability, making interval funds a unique option for investors. When it comes to managing investments, there are 2 main approaches: active and passive. Active management means the manager is hand-picking stocks, trying to beat the benchmark index. This takes effort and comes with higher costs. On the other hand, passive funds simply mirror an index, like the Nifty 50 or Sensex. These funds have much lower costs because they don't try to outperform. They aim to match the market's returns. It's a trade-off between cost and the chance to beat the market. We're looking at a new, simplified regulation designed specifically for purely passive schemes. It's aimed at asset management companies that focus only on index funds and ETFs. The goal here is to cut down the compliance and registration hurdles these companies face. This framework encourages the growth of low-cost passive investing in India, making it easier for investors to access. Importantly, it clearly separates active risk management from the straightforward task of index tracking. This is the SEBI, MF Lite, framework in action. When it comes to individual investors, there are a few important points to keep in mind. First, resident Indians over 18 can invest on their own or with others. Hindu undivided families, or HUFs, invest through the Carta. Minors can participate too, but only through a guardian. Non-resident Indians can invest with repatriable options. And finally, individuals play a huge role in driving industry assets under management, especially through systematic investment plans, or SIPs. When we talk about non-individual or institutional investors, we mean a broad group. Companies, partnership firms, and societies all fall under this category. Religious and charitable trusts often have their own specialized investment plans. Major players like banks, financial institutions, and asset management companies hold a significant share of units. Foreign portfolio investors can also participate, following SEBI's regulations. Typically, institutional capital tends to favor low-risk debt funds, focusing on steady, reliable returns. Let's take a closer look at the variety within mutual fund categories. Each main category breaks down into several subcategories. For example, equity schemes have 13, debt schemes come with 17, and hybrid schemes include 7. There are also life cycle funds and a couple of other specialized schemes. This detailed classification comes from SEBI's circular on categorization and rationalization, issued in 2026, which helps bring clarity and order to the mutual fund landscape. Let's break down the world of equity funds by company size. Large cap refers to the top 100 companies by market capitalization, the giants of the market. Mid cap covers companies ranked 101 to 250, while small cap includes everyone from 251 onwards. Large cap funds are required to invest at least 80% in these big players. Meanwhile, mid and small cap funds must put at least 65% of their money into companies within their respective categories. This helps keep the focus clear and consistent. Let's talk about multi-cap funds, a versatile way to invest across the entire market spectrum. These funds put money into large, mid, and small cap companies, with at least 75% invested in equities and equity instruments. They require a minimum of 25% allocation in each market cap segment, ensuring you don't miss out on opportunities in smaller and mid-sized firms. This approach is designed for long-term growth, giving you broad exposure across the market. It's a balanced way to capture potential from all corners of the equity world. Let's talk about flexi-cap funds, a dynamic approach to equity investing. These funds can invest across any market capitalization, from small to large. They require a minimum of 65% investment in equity and related assets, ensuring solid market exposure. The manager has full flexibility to shift between large and mid caps, with no fixed limits on any segment. This adaptability helps the fund respond to changing market conditions, aiming to maximize returns over time. It's a versatile strategy for navigating the equity landscape. This fund is an open-ended equity scheme that mainly invests in stocks paying regular dividends. By regulation, it has to keep at least 80% of its assets in equity. The focus is on companies with steady cash flow and a solid track record of consistent payouts. Fund managers rely heavily on the dividend yield ratio, that's the dividend per share divided by the market price, to pick their investments. This approach leans more toward value investing, rather than chasing rapid growth. Let's talk about two key types of equity funds, value and contra. Value funds focus on picking stocks that are undervalued, trading below what they're really worth. Contra funds take a contrarian approach, buying stocks that others might be avoiding. Both require a minimum of 80% investment in equities. Importantly, AMC can only launch one fund, either value or contra. And remember, value investing demands patience, since it can take time for the true worth to be recognized. When we talk about focused equity funds, there are some key rules that shape their strategy. First, the portfolio is limited to just 30 stocks, no more. This creates a high concentration risk, since the fund relies heavily on a few select companies. At least 80% of the investment must be in equity or equity-related assets. The fund also needs to clearly state which market cap segment it's targeting. The goal here is aggressive growth, backing only the highest conviction picks. Let's look at sectoral and thematic equity investments. Sectoral funds zero in on one industry, like banking or pharmaceuticals. Thematic funds take a broader view, focusing on big ideas such as infrastructure. In both cases, at least 80% of the investment targets that specific sector or theme. These funds carry higher risk, since they lack the usual protection from spreading investments across multiple sectors. Also, when managing several sectoral funds, their overlap should stay under 50% to maintain some diversification. Let's talk about equity-linked saving schemes, or ELSS for short. These funds invest at least 80% in equities, giving you a strong growth potential. They come with a tax benefit under Section 80C in the old tax regime, which is a big plus. You'll need to lock in your investment for 3 years, the shortest lock-in among popular options like PPF or fixed deposits. This makes ELSS a smart choice for long-term wealth building and efficient tax planning. Let's look at 2 types of short-term debt investments, overnight and liquid. Overnight funds invest in securities that mature in just 1 day, while liquid funds hold securities maturing within 91 days. Both prioritize safety and high liquidity above all else. Because their maturities are so short, they carry very low interest rate risk. Corporates often use these funds to park surplus cash safely, keeping it accessible without sacrificing security. They're a smart choice for managing cash with minimal risk. Let's talk about duration in debt investing, specifically the Macaulay duration, which measures how long it takes to get your money back. Ultra-short-term funds have durations between 3 to 6 months. Low-duration funds stretch that out to 6 to 12 months. Why does this matter? Because duration tells us how sensitive a fund's price is to interest rate changes. The longer the duration, the more the price swings when rates move. These funds aim for slightly higher yields than liquid funds, balancing risk and return. When we talk about debt investments, duration is key. Here, we're focusing on short to medium durations. That means Macaulay durations between 1 and 4 years. The portfolio is designed to adjust as interest rates move, aiming to balance coupon income with potential capital gains. This approach suits investors who have a time frame of 1 to 4 years, offering a way to manage risk while still seeking steady returns. It's a strategy built for flexibility in changing markets. When we talk about corporate bond funds, the focus is clear. At least 80% of the investment goes into bonds rated AA+ or higher. That means we're dealing with high-quality debt, where the risk of default is much lower. This approach offers stability and predictable coupon income, making it a solid choice. It's especially ideal for cautious investors who want exposure to private sector debt without taking on too much risk. Often, these funds track institutional bond indices as their benchmark, keeping things aligned with the market. Let's talk about credit risk funds in debt investing. These funds hold at least 65% of their portfolio in corporate bonds rated AA or lower. That means they're aiming for higher returns by accepting greater credit risk, the chance that a borrower might default. It's important the fund's name isn't misleading, so terms like credit advantage are avoided. Investors should know they face the risk of sudden losses if an issuer defaults. These funds are really only suitable for aggressive debt investors comfortable with that risk. When it comes to gilt funds, we're talking about investments that put at least 80% of their money into government securities. These are essentially loans to the government, which means zero credit risk. The government of India has never defaulted. But there's a catch. Gilt funds carry high interest rate risk. Prices can swing quite a bit as rates change, especially for long maturity gilts, which tend to be very volatile in secondary markets. Typically, the benchmark here is a 10-year gilt index, giving us a clear reference point. We're looking at an open-ended debt scheme that focuses on highly rated institutional and government-backed borrowers. By SEBI's mandate, at least 80% of the fund's assets must be invested in debt instruments from banks, PSUs, and PFIs. These PFIs include public financial institutions and high-grade municipal bonds. The fund invests in a mix of bonds, debentures, and certificates of deposit issued by these entities. Because most issuers are government-owned, this portfolio is often called quasi-sovereign. When managing debt portfolios, one key strategy is to hold at least 65% in floating rate debt instruments. These instruments have interest payouts that reset periodically, based on current market rates. This setup offers a natural hedge against rising interest rates because the coupon adjusts rather than the price. As a result, price volatility stays low. Typically, the benchmark for these funds is a short-term rate index, keeping the focus on current market conditions. Let's break down the hybrid approach, which blends conservative and balanced strategies. On the conservative side, you're looking at mostly debt, between 75 and 90%, with a smaller slice, 10 to 25% in equity. The balanced option splits things more evenly, about 40 to 60% in both equity and debt. It's important to note, the balanced hybrid won't take on any arbitrage risk. Also, asset management companies can only offer either a balanced or an aggressive hybrid, never both. This approach aims to combine the steady income from debt with the growth potential of equity. Let's talk about hybrid funds, specifically aggressive and dynamic types. Aggressive funds usually hold between 65 and 80% in equity, with the rest in debt. Because they have more than 65% in equity, they're taxed like equity funds. Dynamic funds, also called balanced advantage funds, adjust their equity and debt exposure anywhere from 0 to 100%. They use models like price-to-earnings or price-to-book ratios to decide when to buy more equity or shift to debt. The goal? Buy low, sell high, more equity when prices are attractive, more debt when they're not. When we talk about hybrid multi-asset allocation, we're looking at investments spread across at least 3 key asset classes: equity, debt, and gold. Each one gets a minimum allocation of 10%, ensuring no single asset dominates. Importantly, foreign securities aren't counted as a separate class here. This approach aims for true diversification, mixing assets that don't move together. The result? A portfolio that's less volatile and better balanced over time. Let's talk about arbitrage funds, a hybrid strategy that takes advantage of price differences between cash and futures markets. To participate, you need a minimum investment of 65% in equities or equity instruments. The risk here is very low because the positions are hedged, balancing each other out. One big advantage is the tax benefit. These funds are treated like equity funds for income tax purposes. That makes them ideal for short-term parking of money, offering tax-efficient returns without much risk. This strategy blends directional equity, arbitrage, and debt to balance risk and return. At least 65% goes into equity, with a minimum of 10% in debt. Despite the equity focus, net exposure stays relatively low, often between 15 and 40%. This approach offers the tax benefits of equity, but with less volatility. It's a smart choice for conservative investors who want to start moving into equities without taking on too much risk all at once. We call this the hybrid equity savings approach. Let's talk about 2 key funds designed for long-term goals: retirement and children's funds. These are built to help secure income for old age or to meet important milestones like education or marriage. Both come with a mandatory lock-in period of 5 years, or until you reach your goal age, whichever comes first. This lock-in encourages discipline, keeping you invested through market ups and downs, so you don't redeem during volatility. It's all about staying focused on your long-term objectives. Index funds and ETFs are designed to replicate a specific market index, like the Nifty 50 or Sensex. They invest at least 95% of their assets in the same securities as the index. The goal here is a low tracking error, meaning the fund's returns closely follow the market. Because they're passive, these funds are simple to understand and come with the lowest possible costs for investors. It's a straightforward way to capture the market's overall performance. A fund of funds, or FOF, is a scheme that invests primarily in other mutual fund schemes. At least 95% of its investments go into these underlying funds. It can focus on domestic markets, investing in India, or go overseas, targeting international opportunities. One thing to watch out for is the double layer of expenses. Since you're paying fees for both the FOF and the underlying funds, it's important to check the total expense ratio carefully. Overall, it simplifies complex portfolios by wrapping multiple funds into one. Let's talk about specialized investment funds, or SIFs. These funds create a new product category that bridges the gap between mutual funds and portfolio management services. They come with a high minimum investment, 10 lakhs rupees, so they're designed for serious investors. The strategies they can use include equity long-short, but there's a limit. Unhedged short exposure can't exceed 25%. Instead of a traditional riskometer, SIFs use a unique risk band system to manage risk more precisely. Let's break down two key strategies in this space: sector rotation and debt long-short. Sector rotation means the manager moves between up to 4 sectors, aiming to capture the best opportunities as markets shift. Debt long-short uses derivatives to take short positions in debt, adding flexibility. These funds are managed as interval schemes, which means investors have specific windows to exit. They're designed mainly for high net worth individuals, reflecting their higher complexity and a risk-reward profile that's quite different from regular mutual funds. Let's talk about the life cycle fund, a smart way to manage investments over time. It follows a set glide path strategy, starting with a high equity exposure to capture growth early on. As the fund approaches maturity, that risk gradually decreases, protecting the goal corpus. These funds typically run between 5 and 30 years in 5-year steps, and an asset management company can have up to 6 of these life cycle funds active at once. It's a disciplined approach to balancing growth and safety. Let's talk about REITs and InvIT, two powerful ways to invest in real assets. REITs pool money to buy commercial real estate that generates rental income. InvIT, on the other hand, focus on infrastructure projects like roads and power plants. Both are listed on stock exchanges, so you can trade them daily, just like stocks. They're required to distribute at least 90% of their cash flow as dividends, making them attractive for income. Most importantly, they open the door for everyday investors to access large-scale real estate and infrastructure projects. Let's look at how the industry has grown over the past decade. Assets under management surged from just under 12 lakh crore rupees in 2015 to over 82 lakh crore in 2026. That's a compound annual growth rate of 19.3%, a remarkable pace. Unique investor accounts, or folios, reached more than 27 crore by March 2026. We're also seeing a clear shift. Retail investors are moving away from traditional bank deposits toward mutual funds, increasing their share in India's overall financial investments. Let's talk about the SIP phenomenon, a real game changer in investment habits. SIP contributions have surged from 8,000 crore rupees in 2019 to an expected 32,000 crore by 2026. Monthly SIP assets are projected to hit a staggering 15.11 lakh crore. What makes SIPs so powerful? They promote rupee cost averaging, helping retail investors navigate market ups and downs. Even during volatility, retention rates stay high. This steady growth has been a major force behind the mutual fund Sahay revolution. Let's talk about two important types of investment funds: quant funds and ESG funds. Quant funds rely on machine models and algorithms to pick stocks, which helps remove human emotions from the decision-making process. On the other hand, ESG funds focus on environmental, social, and governance standards. They even have a mandatory subcategory dedicated to these themes. Within ESG, transition-related funds specifically target future sustainability, blending finance with responsible progress. These new variants are shaping how we invest today. That wraps up our look at mutual funds as powerful tools for channeling capital efficiently. We've seen how clear regulations keep products honest, and why advisors must grasp fund structures and categories. New offerings like SIF reflect changing investor needs, while steady industry growth signals rising confidence in professional management. This chapter sets a solid foundation for what's next. This video was created with SlideSpeak. Visit SlideSpeak to turn your presentations into engaging AI-narrated videos.